Hello and welcome to our web forum on monetary policy in the COVID-19 crisis, jointly organized by the German Institute for Japanese Studies and the German Center for Research and Innovation. Our main title today is Quo Vadis, Central Banking. When fighting the impact of the Lehman shock 12 years ago, governments worldwide called for more money, and central banks promptly delivered. Today, as governments are fighting the COVID-19 pandemic, its economic consequences, they again call for more money, and again central banks increase liquidity to an unprecedented level. Will such unavoidable short-term policy responses be viable in the long run? Our speakers today will tell us what they think about this fundamental question and how they analyze the present state and future of monetary policy in Japan and in the euro area. And both are highly qualified to do so. They will be shortly introduced by Kazuo Momma, our moderator of tonight's event. Kazuo Momma is an executive economist of the Mizuho Research Institute and had a long career with the Bank of Japan, including positions as assistant governor in charge of international affairs, executive director in charge of monetary policy, director general of the Monetary Affairs Department, and director general of the Research and Statistics Department. So Mr. Momma as well has been following monetary policy, and with his expertise, I think he would also have been a great speaker tonight, but he has to keep back, he has to moderate, and I hope he can do so, but he will have a chance to comment at the end. So our program will be followed by a brief introduction by our moderator, Mr. Momma, and then the keynote by Mr. Nishimura, the keynote by Katrin Assenmacher from the ECB, and then we'll have a moderated discussion, and I will get back to you at the end with some closing remarks. Thank you very much, and I hand over to you, Kazuo.
Okay, thank you very much, Mr. Wartenberger. I am Kazuo Momma. Actually, I think there is broadly speaking, there are two sets of challenges that central banks around the world, particularly those of developed economies, are now facing. Our first set of challenges is with regard to the central bank's fight against the ongoing economic and financial difficulties caused by COVID-19. How effectively are the central banks able to maintain financial stability and facilitate credit flows to businesses and households? Or how effectively are the central banks able to support macroeconomic environment in the context of their mandates of price stability over time. But it is obvious that the monetary policy alone cannot address economic problem caused by COVID-19. Fiscal policy should play a very important role as well. In this regard, one possible issue is that how closely and actively monetary policies should coordinate with fiscal policies or other policies, possibly including macroprudential policies. Well, in any case, any policy issued related to the combat against COVID-19 is the first set of challenges for central banks. The second set of challenges, which are not completely separable from the first one, is about how to achieve the price stability objective over the medium term when policy interest rates are already near or at effective lower bound. This had already been increasingly a challenging issue even before the COVID-19, particularly for the Bank of Japan and the European Central Bank. It appears to me that achieving 2% inflation in sustained manner is extremely challenging for those two jurisdictions, Europe and Japan. Or HICP core inflation in the euro area since 2013 is only about 1% on average. CPI core inflation in Japan has been almost constantly below 1%. not 2%, below 1% for the past 25 years. And maybe these two jurisdictions need more fiscal support, not only from the perspective of the fight against COVID-19, but also with the view of creating higher inflation in cooperation with the central bank. Or in any case, the timing is perfect for discussing these things with regard to profitability objective, now that the ECB has started its policy strategy review. To discuss those issues or any related aspects of the challenges facing monetary policy today, I am very happy to introduce two distinguished panelists today. Mr. Kiyohiko Nishimura is Emeritus Professor of Economics at the University of Tokyo and Senior Professor in the National Graduate Institute for Policy Studies. He was actually with the Bank of Japan as a member of Policy Board from 2005 to 2008, after which he further served as Deputy Governor for the Bank of Japan until 2013. During his 8 years at the Bank of Japan, of course, I very much enjoyed working for him. Another distinguished panelist is Ms. Katrin Assenmacher, who is head of the Monetary Policy Strategy Division at the European Central Bank. She has been in her position since 2016. Before joining the ECB, she led the monetary policy analysis at the Swiss National Bank. She built her previous career through a number of other central banks and universities. We will start today this forum by keynote remarks by Mr. Nishimura first, and then by Ms. Assenmacher. I will give 20 minutes each for each speaker. After the keynote speeches, I will discuss with panelists, hopefully in an interactive way. I am planning to leave the last 5 or 10 minutes for questions from audience. Finally, to the audience, let me tell you that if you have any questions relevant to today's discussion, please do not hesitate. And when you do so, please use the YouTube chat function. Okay, I think that's all I have to say at the beginning. So now let's get started. So I'd like to invite Ms. Assenmacher first for your 20 minutes presentation, please.
Okay, thank you very much. So I'm going to share my screen. So now you should be able to see my presentation. So first, it's a great honor to be here, and I'm very much looking forward to discussing with you after the presentation. And as has already been said by Mr. Momma, this is about the ECB's monetary policy response in the COVID-19 crisis. So starting, as a central bank employee, I have to say that these views are my own and not necessarily reflect those of the ECB. So starting with the ECB's response to the pandemic, I first would like to stress that the COVID-19 pandemic presents a huge challenge to public health and the growth prospects, not only of the euro area economy, but also of the global economies overall. We have witnessed an unprecedented collapse in economic activity. So euro area GDP dropped almost by -12% in the second quarter. We had, in the early phases of the pandemic, large turbulences on financial markets, which now have receded somewhat, also thanks to monetary policy response. And we had a forceful fiscal response that, however, led to a large increase in government debt. The monetary policy response had 3 distinct aims. So first, it was intended to support liquidity conditions and to ensure a smooth transmission of monetary policy. So making sure that the monetary policy support provided really reaches everywhere into the euro area economies. Second, it was intended to help sustaining the flow of credit to households and firms. And in this respect, especially small business and enterprises were important because these dominate the euro area economy, both in terms of output, but also in terms of employment. And these are typically relatively hard to reach by monetary policy measures. So they are bank dependent. They don't benefit immediately from a decrease in the money market interest rate, but we have to take special measures so that credit also to SMEs is becoming more favorable. And finally, the idea was to maintain favorable financing conditions for all sectors and jurisdictions in the euro area. So I will also in my presentation say a little bit more why it's important to really reach the affected sectors. There is a big difference to the monetary policy response in the COVID-19 crisis and to the one in the financial crisis, because in this case, this was a truly exogenous shock. So this was a health emergency. This was not something that originated in the financial sector. So therefore, at the start of the pandemic, banks were relatively well capitalized and healthy. So this was a contrast to the financial crisis where the capitalization and the health of the banking system was at the origin of the crisis. So I would like to structure my presentation in two parts. So first I will give you an outlook of the euro area, and then I will detail the ECB's policy response to the COVID-19 pandemic. So starting with the outlook to the euro area, this chart shows you real GDP on the left-hand side and real value added on the right-hand side. So for real GDP, you can see that there have been growth rates around 2% quarter on quarter over the past 3 years. And with the outburst of the pandemic, growth dropped to strongly negative values. So in the second quarter, there were already some localized lockdowns. So the pandemic broke out in Italy at the end of February. Then the lockdowns in most countries were initiated in the end of March. So this affected already the first quarter, but the second quarter was most strongly affected as most euro area economies had some kind of restrictions in April and May at least. So we see a huge drop in real GDP, and this drop mostly falls on private consumption and also on investment. So private consumption is relatively clear because this is people were not able to go out, they were not able to shop, they were not able to go to restaurants, to travel. So this was kind of obvious. Investment, of course, there was a high uncertainty regarding to the pandemic, and therefore also firms postponed their investment plans and stopped investing. This story is corroborated if you look at real value added. So there we have in the second quarter a huge drop in services because the service sector was strongly affected. Restaurants, personal grooming, all these things where you rely on personal interaction was not possible. Whereas industry suffered a bit because in some countries also the industry was shut down, but overall it was much less affected than services. So we now see a rebound in the third quarter. You can see that on the left-hand chart. But this big increase in real GDP does not bring it back to the previous level. So, and this is what you can see on my next chart. So here you see euro area real GDP levels and in the different countries. And this is indexed to the end, so the start of the financial crisis. So the first quarter of 2008 is indexed to 100, and then you can see the evolution. So if you look at the end, you see this huge drop due to the pandemic, and you see the strong rebound in the third quarter, but this rebound doesn't reach the levels that were there before the pandemic. If you look at the different countries, you can also see very different evolutions across the biggest euro area countries. So after the financial crisis, Germany and to some extent also France and Netherlands did relatively well, whereas Spain picked up only more recently, so starting in 2014, and Italy didn't pick up a lot overall. So already at the start of the pandemic, GDP levels were strongly different across euro area countries. And if you look closely, and I will expand on that later, you can also see that those countries that started from less favorable position were more strongly affected by the pandemic and by the drop in output. The reason for this is that these are countries that are very reliant on tourism. And of course, tourism is services, and these sectors suffered over proportionally from the outbreak of the pandemic. So even though we have a common shock across the euro area countries have been affected to a very different extent. Of course, the pandemic is also reflected in the unemployment rate. So on the left-hand side, the blue line is the official unemployment rate. But you can see this unemployment rate increases starting in March 20, relatively little and relatively gradual, and it's nowhere near the height of the unemployment rate in the financial crisis, which was close to 13% over the euro area. Of course, partly this is due to job retention schemes. And there you see the evidence on the right-hand chart. So these are the number of workers in job retention schemes across different countries. And you can see that almost all countries had a large number in job retention schemes in the spring. It's now starting to decline, but in some countries it's relatively sticky. For example, in Germany, there's still a significant share of the workforce in job retention schemes, and also for Italy, whereas in France, it has declined more strongly. So if we adjust the unemployment rate by those people that probably are discouraged and don't look for a job in this pandemic, and those people that are in job retention schemes, the share of the labor force that's not in work at the moment is much, much higher. And some estimates are close to a quarter. So in the height of the pandemic and still around a fifth nowadays. So it's not quite clear how this will evolve. Uncertainty is very high. On the one hand, one could argue that this is a temporary measure, and these measures intend to keep workers in their jobs and have them being part of the workforce, so to maintain their human capital. But on the other hand, we don't know how the pandemic will evolve and how the lockdown measures and the activities in the long run will look like. So it's also possible that part of these workers and job retention schemes in the end will drop into unemployment. So overall, though the unemployment rate has increased only very, very gradually, it's likely that the gap between these blue and the red curves will somehow narrow, either from above or from below. Fiscal policy has played a big role in the adjustment during the crisis. And what you see on the left-hand side is the draft budgetary plan and the European Commission autumn forecast for the primary, cyclically adjusted primary balance. So you can see that from the previous year, from 2019, where there was almost a balanced budget, it has turned strongly negative to more than 3%. So, and you also have to keep in mind that this is the cyclically adjusted balance. So the unadjusted balance is much more negative, so it's around 7%. So fiscal support has been strong. It's expected to retreat a bit, but over the past weeks, more fiscal measures have been decided. And what has been relatively new and has created a lot of support is especially the fiscal measures that have been decided on the European level. So we have the pandemic support. So we have the Recovery and Resolution Fund, we have the New Generation EU program, which will help especially for those countries that are in an uncomfortable starting position. And that's what is shown on the right-hand side. So there you can see what I already alluded to, that the crisis tends to be more severe for those countries that are already in an uncomfortable starting position. So this is on the vertical axis, you can see the GDP loss that's projected in percent of 2019 GDP. On the horizontal axis, you can see the public debt in percent of GDP as of 2019. And what you see is that to the upper right-hand part, there are countries like Greece, Italy, and Spain, which rely a lot on tourism services and which started with a high debt share into the pandemic and also have a high GDP loss. Whereas countries that are less reliant on these sectors and also have a lower debt are more to the bottom right. So the EU measures will help especially those countries to finance their expenditure and to also create equal living conditions across the euro area. Because as I said, this is an exogenous shock. This is not something that had to be, is due to mismanagement or lacks public finances, but it would be difficult if these countries are bound by their unfavorable starting position in dealing with the fallout from the pandemic. The ECB has published staff macroeconomic projections for the euro area. And because of the high uncertainty, we look at different scenarios that are determined by the severity of the crisis. So the baseline scenario assumes that the pandemic goes on, that stringency measures can be relaxed somewhat, and that at some point a vaccine will be found. So you can see the blue line is the September 2020 projection. It has been revised a little bit upward compared to the June projection because the GDP figures for the second quarter turned out a little bit better than expected. But still, the pre-pandemic path will only be attained at the end of 2022. Then we have a mild scenario and a more severe scenario that show the high uncertainty around the future course of the pandemic, as you see that the range that is spanned by these two scenarios is relatively large. Together with this GDP scenario, there comes an HICP scenario, so a path for inflation. And you can see the big drop in inflation in the course of the pandemic. So we now have a negative headline inflation. So the ECB looks at headline measures, not at the core measures. But also core inflation is at its lowest level since, I think, even since the start of the euro area. Part of this low HICP inflation is due to VAT tax decreases, particularly in Germany. Part of it is due to sales that are more extensive and earlier than they used to be. So we expect a recovery in 2021 when these tax changes run out. But you can see that at the end of the forecast horizon, the inflation rate only attains about 1.4%. And this is far below the value that the Governing Council aims at, namely a value of below but close to 2%. Looking at inflation expectations from survey, a similar pattern can be found. So in the course of the pandemic, different surveys have started to drop. So you can see the consensus economic surveys 5 years ahead, that's the yellow line. You can see the survey of professional forecasters, the blue line, and the Eurozone barometer, the red line. So putting them together gives the green line, and you can see the slide from throughout 2019 up to the end of 2020, which goes from a level that's still quite close to 2% to something that is more like in the order of 1.6, 1.7%. The same message can be seen if you look at market-based measures of inflation that are on the right-hand side. So the dotted line is the 1-year, 5-year inflation-linked swap rate. So the 1-year inflation rate that is expected in 4 years' time, which corresponds broadly to the measure that's on the left-hand side derived from surveys. However, so this is very low and has dropped a lot. However, in this measure, there is very likely some premium in there. So because people use these contracts to insure themselves against unexpected falls in inflation. So if you use a model to back out this premium and to adjust these data for something that is free of this premium, so that's the demand deriving from this insurance motive is calculated out, then you get something that's very much in line with the survey of professional forecasters. So the bottom line is, it's not as dramatic as it looks when you look at the inflation-linked swap market, but still it's something in the order of 1.6, 1.7, which is clearly below the 2% that these measures used to fluctuate around in the past years. So I'm now coming to the policy response. The ECB took a wide range of measures in spring in particular. And these measures, the core measure was the initiation of the Pandemic Emergency Purchase Program, which has an envelope of now 1.35 trillion. It was initiated in March, and it includes all asset categories that are also eligible under the usual asset purchase program. The traditional asset purchase program was expanded by an additional amount of 120 billion. There were new assets that were bought in the PEPP, especially the commercial papers and Greek government bonds. We also recalibrated the targeted lending operations in order to reach firms that are bank dependent. So the interest rate was lowered twice, first in March and then again in April. There was a series of bridge operations and backup operations. We also initiated swaps with non-euro area central banks. So overall, there was a very wide range of measures to address these turbulences in financial markets that threatened to impact on the monetary policy transmission mechanism, and also to make sure that banks are able to extend credit to firms that were in need. So these two charts show you the impact of the measures on the markets. So on the left-hand side, you can see the 10-year sovereign yield spread versus the 10-year overnight index swap rate. So this is a spread over an average euro area risk-free rate. And you can see that with the start of the pandemic, especially the vulnerable countries like Italy and Portugal and Spain saw large increases in their spreads. With the initiation of the Pandemic Emergency Program, which is the first solid line, first vertical line, you can see a drop in the spread. With the recalibration, it has declined again, and spreads are now back around their pre-pandemic level. If you look at the big chart of the left-hand part chart, you see that these increases in spreads are nowhere near to the increase that we witnessed during the financial crisis. So the monetary policy response has been effective to keep transmission in the euro area at a smooth and to ensure working monetary policy transmission. On the right-hand side, you can see a chart which shows how lending to non-financial corporations has evolved. And you can see with the start of the pandemic, the big increase in lending rates. So on the right-hand side of the chart, you can see a breakdown according to countries, and especially in April and May, in all countries, lending has increased significantly. And this helped to keep companies afloat during the lockdown. Of course, this is also aided by fiscal policy measures. So many countries had guarantee schemes for loans. And these were very essential in helping banks to provide these loans. But this went hand in hand with the favorable liquidity provision through monetary policy. So I would like to conclude. As I said, the ongoing pandemic had is a difficult situation for the economy. And going forward, economic prospects are highly uncertain because nobody knows how this will evolve and how much of these changes that we are seeing will be structural and permanent, and how much of those will be rolled back once vaccine is found and once we can better deal with the health issues. The impact on economic activity has been huge, with an uneven and incomplete recovery, both across different sectors, but also across Euro area countries. Policy has been able to cushion the immediate impact. So monetary and fiscal policy have worked hand in hand. So monetary policy has kept financing costs for government low. Governments have taken measures that help the economy, where monetary policy can provide support as well. Monetary policy overall has remained favorable financing conditions for all sectors and for all jurisdictions. But of course, the long-term consequences and the extent of the permanent damage inflicted by the pandemic are still highly unclear, and it remains to be seen how much structural change will come from this pandemic. So, and I stop here. Thank you very much for your attention, and I'm handing back to Mr. Momma.
Thank you very much, Ms. Assenmacher. I apologize for having made a mistake about sequence. I should have introduced Mr. Nishimura first, but I hope you don't mind, and also I hope sequence doesn't mind that doesn't matter at all. But in any case, I have to apologize for any inconvenience it might have caused. Okay, now let me introduce Mr. Nishimura. Please start with your 20 minutes presentation. Please unmute. Mr. Nishimura, unmute, please. Nishimura-san, unmute, please. Nishimura-san, do you hear me? You are still on mute. Yeah.
Oh, can you hear me?
Yes, now I can hear you.
Okay, so I will do that.
Again, please.
Can you see my slide?
Yes.
Okay,
yes.
Oh, that's great. Yeah, thank you for Professor Franz Waldenberger and for your very incisive introduction. And it's a great pleasure to join Katrin Assenmacher in this web forum. And in particular, in this web forum, my old friend and former colleague, Mr. Momma, for a good start of this very interesting topic where we are now in COVID-19 crisis and what is ahead of us. I first want to clarify my stance. The view I expressed on my own, of course, and it may not be, it may be markedly different from official views of the Bank of Japan. I left more than 8 years ago, and the things have changed. But in my heart, things have not changed so much. That is my kind of things. But I believe that my view expressed here is a commonly held public perception, which is important constraint with the real conduct of the central bank, the Bank of Japan. To put it simply, it is a kind of a quote, weak and quote, dual mandate. The price stability as a prerequisite of a sound development of a national economy, and the implicit emphasis for me is on the latter. And thus it is not price inflation that we should consider only, but the level of economic activities are more important in policy making. And the second slide, another important point is that the nature of the price target. So we will talk about, I think, the 2% inflation target at the end of this discussion. The wording of a 2013 document is a bit complicated. I'm keep joking all the time that this complication is partly because of Mr. Momma, today's moderator, was heavily involved in making these documents when he was at the office at the Bank of Japan. The most important part of this document is that quote 2% and quote is long-run goal, particularly when the governments and other entities' efforts are successful. So that is my policy stance first. And the policy issues right now, which we should consider, is the four things. Are there a sufficient number of measures? And the second, are they immediately effective, especially with respect to financial stability? And are they sustainable after the COVID crisis ends and fades? My point is that the COVID-19 crisis is not forever. It's stopped somewhere else, sometime else. So the most important thing is that the sustainability of our commitment made today. And the fourth one, which is also related to the last part of Assenmacher's point, there are the long-run problems the Bank of Japan faces after the COVID-19 crisis. That is actually the price inflation and inflation expectations. And the question to the first answer is very simple. Bank of Japan is very well equipped, and a large number of instruments already existed before COVID-19, and they greatly expanded at the time of COVID-19 crisis. And the most important is that we have a very large market interventions, which is increasingly directly aimed at markets, especially the direct resource allocations like ETF and J-REIT. And also ample liquidity provision beyond the border is very important. I will talk about later. And also a very lavish lending support. Those are mostly for large corporations and banks at first, and then it is included now small to medium-sized firms. But the basic idea is it's a trickle-down economics. And this is an example of a very effective first actions of central banks. The left-hand side is a Federal Reserve currency swap. Bank of Japan's is a huge currency swap with the Federal Reserve Bank, FRB, and then Bank of Japan supplied dollars to Japanese banks, and the Japanese banks really kind of rescuing bond markets in the United States. So the first and the immediate response is very good. So where are we now with respect to the real economy? So the sound development of the national economy. We have a very sharp decline from even declining growth trend before COVID-19, but it's a surprisingly quick recovery expectations, except for services. This is the left-hand side. We have a real GDP growth. Growth is trending down but the decline from that is tremendous. But at the same time, the right-hand side shows that the at least from domestic sentiments, the so-called economy watcher survey shows a quick recovery as of September. So manufacturing recovery is real due to the fact that the reopening in manufacturing is comparatively easy and the preventive measures are relatively easy implemented. Moreover, the strength of the Chinese economy it's amazing, and it helps manufacturing a great deal. In contrast, problems remain services, especially face-to-face services, and the Medicare and the nursing care services, and this has a very big impact on inflation in the next slide. So, and then here is that if you look at this one, the commodity price, less food and energy, shows a very sharp increase. And in contrast, services, less imputed rents, is a sharp decline. They are from the face-to-face services. So the one slide back, first we have the initial deflationary dominance. But at the same time, there is a conflicting force about price recovery, price stability. So face-to-face services, the employment which employing poor to lower to middle class people, employment is lost, wages and their permanent incomes are down, and thus its end up is deflationary. In manufacturing, this I will show here. This is something like that. The prolonged, the main issue is that the medium to long run effects on inflation. A prolonged slow growth in services, including medical and nursing care, we see right now an increase in unemployment. And Japan is very curious because there is a very long lag between the incomes growth, between the GDP growth and the unemployment. So this is, I call it the long-lagged Okun's law, and which is downward sloping. And because of the a very severe employment situation, this is a wage Phillips curve of Japan, and we see a kind of another downward shift of wage Phillips curve, and which means a lower demand and deflation. But at the same time, there is a forced saving and pent-up demand, which leads to inflation. We have a very gorgeous, not gorgeous, but generous income transfer, and which ends up with a very huge forced household savings. So the point is that the future these savings and the pent-up demand are supposedly very strongly inflationary. As the sheer size of forced saving here, it's a forced saving. And so here I am kind of discounting positive effects of new precautionary demand for new normal. But I think this is very important to know that the pent-up demand, and that is very inflationary in the future. So we have now the tug of wars for price stability in the medium run. The deflationary face-to-face services sector's effects should be minimized, as I said before, but at the same time, the inflationary dissabling effects should be maximized. So this tug of wars is very important for the price stability in Japan. So my point is that to achieve price stability, I'm not saying that 2% inflation target, which I will talk about later. The coordination and mutual commitment between fiscal and the monetary authorities are desirable. So the situation becomes increasingly difficult as COVID-19 crisis lingers longer. Right now, in 2 or 3 days, right now, we see another increase of cases, infection cases here and there, and which is scary. And then we need a closer coordination and mutual commitment, which is simply and easily understandable with the public. So I will talk about first the fiscal side. The commitment or agreement is desirable with the fiscal authorities about how long and in what conditions the situations, the stimulus continues. This is especially important to minimize the deflationary pressures on face-to-face services sectors, and including medical and nursing cares. And the other important issues, which is not in the slide, but I think it is important, is that the reform of government procurement toward more quality-based ones. And also there is a kind of vicious spiral of low private wages, which leads to the low public wages, and then it's translated into again low private wages. This kind of spiral in local areas should be stopped. So in my understanding is that this is a kind of reverse incomes policy which we need, especially in local governments. And I want to present one example, which is the most important lessons in the 1990s. People are kind of accusing the monetary authority, their monetary policy easing is behind the curve. But the point is that the fiscal policies was consistently tight, and the land value taxes and the very strong opposition to capital injections to troubled financial institutions. And the Ministry of Construction, this is my own experience, the Ministry of Construction refused to assess that the land prices were undervalued of the Regulatory Reform Committee, even in the late 1990s. And also the 1990s, it caused so-called price destruction, deflation, and disinflation. And the government is welcome. Was welcome the move because they think that it's a collection of high domestic foreign price differentials. So in that sense, price decrease is not a bad things for financial fiscal institutions. So this is a CPI I will talk about later. So to achieve a price stability, on the monetary side, we need a kind of additional asset purchases in targeted sectors. I think that is appropriate because this is the kind of a credibility issue. So the Bank of Japan also committed to the price stability, And also at the same time, the government, especially local governments, are not so quick to implement a kind of structural change initiatives. But the bank, through their own direct interventions in resource allocations, for example, purchases of targeted sectors and the an appropriate supplement to kickstart particular sectors through bond issuance and also the REIT, ETF and REIT or something like that. So with respect to the 2% flexible average targeting, I think in principle, in the long run, central banks in inflation targeting should be aligned properly. So the recent kind of a debate about flexible average inflation targeting and other things, that is, I think, it's no issue for us because the 2% is it's not in our radar. So I will talk about later, possibly maybe in the discussion. So, but the long run 2% it's a target which should be maintained. That is my point. The problems of the 2% is stems from the three facts. The first one is long-run inflation expectations implied by the Phillips curve was already and substantially below the 2% target between 1983 to 1995. The second fact is that from 2005, surveys of long-run inflation expectations have been stubbornly stable around 1% and far below the 2% target. And so from my viewpoint, Assenmacher's the kind of concern about lowering inflation target or inflation expectations may not be the problem for us in some sense. And from 2019, surveys of long-run inflation expectations moved downward. This is a problem. We should raise the inflation target on this side. So, this is all about the current Japanese inflation expectations history. So, so my point is that can the COVID-19 inflation stimulus effects change 1% stability of inflation expectations? It may be, but because the change in inflation expectations are sometimes quite abrupt and drastic. So be prepared in case, however, the most observers, including me, think that they do not change 1% target of inflation expectations. In this case, we then stick to the point that what is important is to maintain the price stability. The coordination with fiscal authorities is the most important things. Thank you so much. That is all about I want to say.
Okay, thank you very much, Nishimura-san. Okay, those your two presentations were both very insightful and very impressive, and also very informative about what's going on, what your insights on inflation dynamics, particularly from Nishimura-san. One thing I am now interested in the situation in Europe is that now second big wave of COVID-19 might be coming to European countries. And as a matter of fact, several cities are already in lockdown. The obviously situation is quite different from what ECB might have thought in the previous or maybe September governing council. So obviously you show the chart, nice chart with the standard scenario, moderate scenario, severe scenarios, and so forth. But actually, September blue line standard scenario looks increasingly too optimistic given the situation right now. So, what is the assessment of the near-term outlook, particularly the fourth quarter of this year for European countries? Now, market people are looking more for negative growth for the fourth quarter. Do you agree with that? And how the European Central Bank is going to respond to the situation in the next Governing Council meeting in December. Already, Governing Council President Christian Lagarde said that the ECB would probably recalibrate parameters of the policy tools in the next meeting. And is that going to be big change, or it's going to be slight modification or something like that? Of course, this is up to the Governing Council. So if you have any sense of your own, that would be very helpful. And another thing is that how fiscal authorities of European countries is going to provide sufficient support for combat against current situation. You alluded to the kind of fragmentation and also disparity across European countries in terms of the budget capacity and how severe situation is for each country. So the kind of the inequality situation across European countries will be sufficiently corrected by the fiscal authorities and measures. What do you think about that in the medium term, particularly in near term, but also medium term?
Shall I respond immediately? Yeah. Well, of course, the situation has worsened in the recent weeks in the euro area, and therefore the Governing Council at its October meeting already indicated that when the December projections will be finalized, so staff, of course, at the moment is working on these projections and is looking at the measures and the figures, and we will release new projections in December. And then the Governing Council will reassess the situation and also decide whether to recalibrate and what form to recalibrate. So the statement at the October meeting was already that it was indicated that there is an upcoming, so the Governing Council will look at all measures to decide how to respond to the unfolding situation. If you look at the September projections that I showed and that are also available on the ECB's website, you can see that there is a baseline scenario which doesn't assume that everything is fine. So there are still restrictions and lockdowns being imposed until next year spring. But it, of course, didn't really impose something that is escalated again. But we also have a severe scenario. So there are kind of different views already in these projections embedded. And I also would like to remind you that during June, there was a positive surprise. So from June to September, the second quarter figures looked a little bit better than we had expected. So there's also hope that now countries know a bit better how to impose a lockdown and how to keep essential sectors open instead of going all across the board and stifling the economy even more. As regards fiscal, we have a response on the European level. We have, this is only being finalized and will be rolled out in the future. And we also have some measures from the countries that impose renewed lockdown measures. So I know best Germany, together with a renewed lockdown, there was also renewed support for businesses that are affected. So this goes, of course, also hand in hand. Thank you.
Okay. Okay, good. Nishimura-san, I have to ask some question, okay? You actually comprehensively discussed about the inflation dynamics in Japan for medium and long term. And on one side, you provided some optimism about possible inflationary pressure arising from COVID-19. But at the same time, you sound more pessimistic about the medium-term, long-term 2% inflation objective, because you propose that more cohesive coordination between fiscal and monetary authority, which indicates that BOJ alone cannot achieve 2% inflation in the medium term or long term. And actually, as a matter of fact, Japan has never been hit 2% inflation for the last 25, 30 years. So I think if history is of any guide, I think any pessimism is very reasonable at this juncture with regard to the medium to long-term outlook inflation in Japan. And my question is that you alluded to the more formal coordination between the fiscal authority and monetary authority. Does it mean that the joint statement you mentioned earlier, joint statement about 2% inflation targeting by the BOJ, which was discussed in 2013 January? By the way, I made it intentionally complicated because you know that it would be very, very impossible for the BOJ to achieve 2% inflation anyway. I knew that, and it was only because of political pressure at that time. So there is all reason that everything should be led very complicated way. In any case, this is a situation in Japan. So I think it is very realistic to assume that Bank of Japan alone cannot achieve 2% inflation. But how effectively do you think government and Bank of Japan would coordinate their policies, including modification of that joint statement?
The first thing I want to add is that the second wave, as first is Katrin's point. The second wave will be very different from the first wave, and I hope. And since we know the COVID-19 and also at the same time how to prevent it, and yes, we have the kind of increase in the new cases and other things, but the point is that the fatality rate is going down. Just look at Donald Trump. And he is in the very high risk class people, but he survives, at least not in a presidential race, but the race for life for COVID-19, he survived. And also the other stuff around him, as a new treatment or is going on, and I suppose this is also the case in Europe. So the most the frustrating point is a collapse of Medicare, and the AFC Medicare system is still working, and I think we should expect a relatively good recovery, and and that is a point which I am kind of hoping for, and also it will be in the data in the future. And with respect to the January 2013 the statement. Yes, it is. I know. I know Momma-san's extreme effort to do that, and I was at that time so frustrated with respect to the government's position, and also at the same time with respect to the kind of stubbornness of our position at the same time. So but things have changed, and the people are becoming more and more kind of cooperative. So in that sense, and also what I'm suggesting, it's not a kind of revolutionary or sea change. Yeah, but it's a continuation of what we have been doing for a very long period of time. And also at the same time, we have somewhat kind of built-in stabilizing method of yield curve control and other things. Yeah, so in some sense, I think the kind of new commitment or new agreement is relatively easy. And the point is that the kind of the assurance to the public that we are in right track, and to avoid any kind of crashes or something like that, even though the 2% may be far away. But anyway, it's far away for almost 30 years. So only 10 years, it's not so long.
Okay, thank you. Well, probably I think that I have to discuss about the Eurozone inflation as well, because the Euro area inflation dynamics is not as bad as Japan, but still not sufficiently good from the perspective of ECB. And that's exactly why I believe that ECB is now taking policy strategy review. The outcome of which will be probably next year, maybe sometime next year. A Federal Reserve earlier already adopted average inflation targeting, and also they pursued for as low unemployment rate as possible. So this was kind of significant change in terms of monetary policy framework. And I think it is very difficult for ECB to go in the other direction. As Mr. Nishimura said, all the central banks across the world are supposed to be more aligned in terms of their policy goal. Otherwise, that could be a turbulent to the financial markets, including particularly exchange rate markets, so on and so forth. So I think the presumption is that ECB is likely to follow suit, or possibly at least in that direction of the Federal Reserve, to committing 2% inflation more strongly. But the question is, what is the tool to achieve that? And achieving that ECB Eurozone inflation rate is going to be below 2% for the next 5 years or so, which cannot be completely ruled out given the past history. Still, ECB is going to continue to implement the aggressive monetary policy with negative interest rate and right asset purchases, 5 years, 10 years. Is that your possibility? Do you think is it possibility, or do you think at some point maybe ECB has to or coordinate with the government, as Mr. Nishimura said, to create a higher inflation with the cooperation with the government? What is your take stock of that?
These are many questions, I must say. So I hope I won't forget any aspect of. First, as compared to the Federal Reserve System, of course, the Federal Reserve System has a dual mandate. It has maximum employment and price stability, whereas in the European treaties, there is a single mandate for the ECB, and that's price stability. So therefore, concluding from that both institutions have a strategy review, concluding from that fact that we also have to go into the same direction as the Federal Reserve, I think is not the right conclusion. So we will look at our strategy and review it independently of what other central banks have done. And of course, the definition of price stability is a key topic in the strategy review. And one reason is that, of course, we have these long lags in monetary transmission, so we have to look ahead. And there the question is, what models do you use to assess your monetary policy effectiveness on the inflation rate? And models that give a big emphasis to expectations, like the usual expectation-based models, of course, imply that these inflation expectations play a major role in shaping economic agents' decision and in bringing inflation back to target. And this is something we will very closely look at in our strategy review, also looking at what kind of expectations matter most. So we usually look at financial market expectations or expectations of bank analysts, but there is much less known about expectations by firms and households, which probably are even more important in shaping economic decisions. So this is a wide array of things. And there is another particularity of the ECB is the kind how price stability is defined. So at the start of the European Monetary Union, price stability was defined as an inflation rate of below 2%. And then in the first strategy review of the ECB, this target was concretized by saying we want to have below 2%, but close to 2%. So now some people think that this is kind of an asymmetric target. And this is something we will review because you are probably more active when inflation moves above 2% than what you are in doing below 2%. So one interpretation would be it's kind of an asymmetric target. The other interpretation is it's a symmetric point target somewhere at the point a little bit lower than 2%. And these are, of course, the questions we are looking at. As regards fiscal policy, of course, again, the euro area is specific there because we don't have a single fiscal authority. So the European Central Bank is independent, so we are not going to coordinate with fiscal authorities. But in addition, there are 19 different fiscal authorities that can set different fiscal policies. So therefore, it's very helpful that now at the European level, there are initiatives being taken to also have a fiscal response on the European level, which hopefully will help to address these associated problems that I also exposed in my presentation with government bond spreads reacting very strongly to the severity of the crisis and also to the severity of the government debt situation, which makes a transmission of a uniform monetary policy even more problematic. Thank you.
Okay, thank you. Nishimura-san, very different topics because you mentioned that the BOJ can be more constructive in terms of the resource allocation, not just price stability, but coordinated with the government in terms of resource allocation. In this context, the one big topic in global economy right now, particularly in the European area, is that the climate change. Do you think that the BOJ should be more aggressively address climate change through whatever central bank can do?
Yeah, this is my own point too. And it is not only the climate change, but also the other kinds of innovative activities and other things. Yeah, the decline of TFP recently is quite alarming. After it's very ironical. After the 1913, after the Kuroda's QQE, Japanese TFP is down from almost 1% point or something like that. That is quite ironical, and this is somewhat because of the innovations are controlled by mostly large corporations, and also at the same time, the kind of small to medium-sized corporations are very hard to get kind of new ideas. They have money, but they don't have ideas. So in that sense, I think it is important to have some kind of so-called real growth enhancing bank policies, which I started when I was the BOJ at that time, and it is not so popular at that time. But I think that kind of thing is very important, because the many issues are need a speed, the real speed, and the fiscal authorities are not good to do that. And the best policy is that to make a kind of bond ETFs or the other kinds of instruments to kind of to redirect the money to more innovative activities, and also the green activities and so on. And I think the Japan overlooks its vulnerability to climate change, and also the all kinds of earthquakes and the rainfalls and heavy rainfalls and other things. So from outside, sometimes it looks like there is no place to live in Japan, which is safe enough for almost 100 or maybe 300 years. That is the point. We need to make some kind of improvement to do that, and the very speedy actions by the monetary authority, or I should say by the kind of financial authorities, are very important to make things happen.
Interesting, but very, very ambitious. Stability alone is a very, very daunting challenge, but also central bank has to take care of the growth enhancing, climate change, and even earthquake. It's unbelievable. In many cases, I understand that there are so many possible challenges that central banks still face.
Yes, it is a very challenging, and also it's challenging for all, and especially the climate change is challenging for all. But we should also change our mindset, and so there is a kind of dichotomy in the kind of joint government. The fiscal authorities are fiscal authorities, and the monetary authorities are monetary authorities, which only for price stability. The fiscal authorities is only for resource allocations. But that is not suited for rapidly changing environment, economic environment before us. That is my point. And so it's, I think it is more important than the flexible inflation target or average inflation target or asymmetric inflation target, just to increase our growth potentials. It's very important. And also at the same time, the fair growth potentials, because it is becoming more apparent that the globe is a kind of divided between the small number of wealthy people and the large number of not poor, but lower middle class people whose jobs are really replaced by the robots, and it's a physical robots and also the software robots, and in some cases, and maybe a bunch of Bank of Japan's personnel and also ECB personnel will be replaced by soft robots or something like that.
Okay, thank you. Marcus, do we have any questions from audience, or do you have any question of your own?
Yeah, thank you very much. I still have a lot of questions, but let me focus on only one. We already talked about the question of climate change and so on, but I want to ask about the public opinion about that. I mean, according to Stefan Gerlach, we have a time where central banks facing a new golden feathers moment, referring to Barry Eichengreen, the famous American economic historian. And according to Stefan Gerlach, public opinion is not on the side on central banks and central banking. One example is the climate change, and the other example might be wealth inequality. We still face very high stock prices, and stock prices continue to be optimistic. And I want to ask both panelists, what do you think about the importance of a public opinion in modern central banking and in monetary policy making? Thank you.
Can I first go? Actually, that is the basic, the thrust of the basic message I want to try in my presentations. And it's in some sense, the banks, so it's a kind of, banks should address the need of the people, the ordinary people who are mostly lower middle class and the kind of threatened people, and in that sense, the bank should be more kind of, in the sense, progressive compared with the very conservative in the last, with respect to the, especially for a kind of trickle down economics type argument. I may be wrong. I may have some argument with Katrin with respect to that. I think the public opinion is now becoming the third most important determinant of the monetary policy right now.
Well, of course, central bankers would like to do good and are nice people. I fully agree with Mr. Nishimura on that. But on the other hand, central bankers are not elected representatives, and they have got a set of tools that they can use. And the question is whether these tools are the most suitable ones to do these things, and whether central banks are put into a position to address these things. Of course, we are not sitting in an ivory tower and out of the world, and we are, of course, seeing the public discussion regarding to climate change, to wealth inequality, and all these issues. But the question is this the task of central banks? So they are set, they have treaties to pursue price stability. And of course, this will have side effects that need to be weighed against achieving the target of price stability. But on the other hand, how much can a central bank do to look at climate change? Is it a central bank's task to find projects that increase growth and do increase total factor productivity? If it can be done together with achieving the target of price stability, that's fine. But if there is a conflict, or if there is something that the central bank has to do that goes beyond the treaties. And I would just like to remind that in the European treaties, it's also stipulated that the central bank should act in accordance with market neutrality. And this market neutrality is very important because it assumes that the central bank does not have a superior knowledge of what is good for society. And that in the end, this task is assigned to politicians, whereas the central bank should be technocratic and pursue a target that's not as attractive to the public as these hot topics like inequality and climate change, but it's more adapt to the instruments that the central bank can actually use.
Yeah, thank you very much. We are running out of time, but before...
Can I add one thing? One point is that we are always talking about price stability, but price stability for whom? Actually, price stability is very heterogeneous. So in that sense, just to know about how heterogeneous price stability is the knowledge, I think that is very important. For example, in the case of Japan, the older people face a higher inflation rate compared with the younger generations who are kind of beneficiary of new technology.
Okay, thank you very much. I hope that the ECB's policy strategy review will give us a good answer to that. Thank you.
Yeah, thank you very much. Before closing, I want to take the last 2 or 3 minutes to get to raise some question from the audience. I mean, we already tackled some of these questions, but Kojima Sakuma asked regarding the green issue, obligations to be green in corporate activities might become additional cost of everything. Could this factor help us to achieve a comfortably higher inflation rate in the future? And Mr. Daniel Baburek asked, the humanitarian side of the COVID crisis has allowed central banks finance fiscal spending as acceptable. Is that the true impact on central banking? I would like to give the panelists 1 or 2 minutes to address these 2 questions. Thank you.
Yeah, at one point there's kind of green bonds, other things. If the this is not particularly the instruments for increasing inflation or something like that. That is the end result of the choice of the people. So in that sense, it depends on the choice of the people, and if the choice of the people is kind of inflationary, and then it is good. And whether it is the green bonds or the other kinds of things, but the choice is on the people.
Yeah, maybe. So of course, climate change has a lot of impact also on inflation. I would just like to mention carbon taxes, for example. So and that is one reason why central banks have to look at climate change and mitigation measures and how it would impact on their modeling, on their inflation forecast and everything. So it goes far beyond of the question whether you should buy green bonds or not. There is a wide range of issues that goes beyond gearing monetary policy to additional targets. The other thing, as regards fiscal policy, in the current situation, of course, monetary and fiscal go hand in hand. Fiscal can do things that monetary policy cannot do. So I showed that the recovery is very uneven. So fiscal can target specific population groups. It can target specific sectors, whereas monetary policy can ensure that financing conditions remain favorable. So at the current point, both go hand in hand. So as long as inflation is below the target, there is no conflict between money and fiscal policy. And if each policy area does their tasks, then things will coordinate more or less automatically without any formal coordination measure.
Yeah, thank you very much. I want to thank both speakers and also the moderator for the great discussion. And the final words before we're closing this forum belongs to Professor Franz Waldenberger. So please.
Yes, hello, and thank you very much for this really insightful presentation and discussion. I learned a lot. I mean, we are in the midst of yet another historic experiment, and there's a lot of uncertainty around. What I learned today is, well, a positive note. I'm not sure whether we overstretch the expectations with regard to the potential possibilities of monetary policy. I was surprised that it's not only about price stability, we can also discuss other issues like climate change and inequality in the context of monetary policy. But of course, everything is interdependent, everything is connected. So. But I think, was quite impressed by the sophistication of instruments and at hand, sort of at the disposition of central banks. I think there is a lot of need for coordination, not only between central banks, monetary policy and fiscal policy, but also international coordination. And I hope this will improve with the election results in the United States. I look forward, I mean, we as the DIJ are happy to support this international exchange on such topics, important topics. And I hope you will be with us in the future again. So thanks a lot to all of you. Also, to Markus, who initiated and coordinated the whole event. Thank you very much. Also, thanks to our host, technical host, Mr. Yamauchi, who has not been visible. And I also thank the audience out there in Japan, in Europe, and other places. From Japan, I can say good night now, but for those in Europe, I would say have a nice day and hope to see you again. Bye-bye. Thank you.
Yeah.
Thank you. Have a good night.
Well, thank you. Goodbye.
Bye-bye.
Thank you. Bye-bye.